Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So today we're looking at Texas Instrument, which is a semiconductor company, and you guys have asked me to look at it, so that's what we're going to do today. I don't want to make the video long, so we'll make it very short, and I want to go over the business side of things and what they do, and then we'll talk about the financials. But before we do that, as always, I would like you to join us on the Patreon account, where if you just pay this much, you can basically get access to all of these things and access to the Discord, inshallah. And then if you have any questions, you can let me know and so on. It really helps the channel. So thank you to everybody, by the way, that have joined the Discord lately. And everyone that joined Patreon. There's a lot of you guys, by the way, that are on the Patreon account, but you haven't actually joined the Discord. So if you have access to the Patreon account, definitely go for it. Okay, if you got a Discord account and if you're not that sort of a person, that's absolutely fine. I get it, but it would be really nice because there's a lot more people on the Patreon than actually the Discord. So inshallah, join us if you can. That would be absolutely wonderful. So the company that we're looking at today is Texas Instrument. Texas Instrument is in the semiconductor basically sector, and when you look at the basically year to date, the company has basically performed almost a flat. It hasn't done anything, and the last 6 months is down about 9%. So it's interesting to look at it right now, and then just about 5% for just this month. So what I want to do is I want to look at the financials, but before we do that, let's just talk about the company generally. The company basically has two major things. It has basically the analog and the embedded processing chips. Okay, so those are the two things that they do. And it was founded in 1930s in Texas, and it has a lot of customers, employees, if you think about it. And when we look at the revenue breakdown, it will be interesting to see. Right, so you got the analog is about basically over $15 billion. Of the 20 comes from just the analog devices, and then the embedded basically is about 3.2, and then you got 1.4 billion dollars of that revenue coming from other devices or other things. But they made $20 billion in 2022, but they spent about $2.8 billion in terms of capital expenditures. And then research and development, it was only $1.7 billion. So this is actually very basically efficient. So the management are doing really great job in terms of managing the capital expenditure. So they bring the expenditure down. Research and development is spending quite a lot of money, which is quite good. Okay, and their revenue is actually growing. We will look at that in a second as well. The key markets that they're in are industrials, automotives, personal electronics, communication equipment, and enterprise systems, and others as well. So you can see it's very well diversified, but a lot of it is industrial side of things. So we will see what that entails in a second. So from revenue side of things, it's actually interesting. Very diversified portfolio of products that they have, but 77% of their revenue comes from the analog side of things. And if you're interested and want to know more about the company, if you go to the investor section, you'll find this file basically that is mainly for investors. Okay, investor overview. You can find a lot of information about the company, when it was established, on all of that stuff, the ambition, being good and corporate citizens, and all of that. Basically things they want you to know about the research and development, and then you can find out the breakdown of their revenue inside of it, which I've basically showed you now. And as you can see, 77% of that revenue actually in 2020 came from the analog, and then embedded was about basically 16% and 7% for the others. And then they talk about why that is and what that entails and so on. So there's a lot more information in that on that website if you are really interested in that sort of a thing. Let's now have a look at the financials, because that's what we came here for, to see if this company is a buy. So once you understand the business model and you know the trajectory of that business, okay, the next thing is to see if the company is a buy right now, and that's what we're going to do now. Okay, it has a market cap of $151 billion, so it's a huge company. It's not small at all, and it has a wide economic mode, and the beta is quite low. So this is really good. And now looking at PE right now, basically PE is about, just let's call it 20. Okay, the sector we're looking about 34. So the technology sector in the S&P 500 right now is about 34. The S&P 500 itself, the whole general market, is actually about 25. Now the forward PE is about 21.5. The average for the last 5 years, we're looking about 21. So based on the current PE, it seems slightly cheaper. Based on the average last few years. If you compare it, the current to the last 5 years, it seems basically cheaper than where it used to trade. Price to free cash flow will come about 46, and PEG ratio of basically 2.5. Okay, in terms of dividend, this is where the company shines. You've got over 3% dividend yield. We've got a payout ratio of 56%, which is slightly high, but I'm sure they can bring that down. Latest increase was 7.8. This, I think they've increased it again recently. I think in the last couple of days, I think. So after I've done the research, I think they might have increased it. We'll check that in a second. The 5-year growth rate is about 17%, which is absolutely huge. And they have increased this dividend for almost 20 years now. If they get to 25 years, that will the company will become a dividend aristocrat, which is a company that have increased its dividend for 25 years or more. The annual payout for this company is about basically $4.96, so it's quite healthy. And the dividend safety is 90%, which is very, very good. Anything above 61% is very, very good. Free cash flow. So the reason we look at it, by the way, is to make sure the company does not cut the dividends. Because you've got, if a company is like in the 20s, in the 30s or 40s, 50s, even up to all the way to 60, they can cut anytime. They can completely cut that dividend. And the reason is because they don't have enough revenue, or the net income is declining, revenue is declining, or whatever. They don't have enough free cash flow. They go in negative when it comes to free cash flow. Anything can happen. So we just need to make sure that if you are a dividend investor and you're looking for that income, you want to make sure you buy a company that has a healthy dividend safety as well as the payout ratio. So this tells us a lot. Okay, that tells us a lot, and is easy to calculate as well. Free cash flow, you were looking about free cash flow. Right now we're looking about over $3 billion, and free cash flow yield of over 2%, and free cash flow margin of 17%, which is absolutely huge. Now, profit margin, we're looking at over 40%. Operating margins are basically over 46%. Return on equity, we're looking about 50%, which is absolutely amazing. In terms of total return in the last 10 years, this company has returned about 17%. Now, this doesn't tell us, of course, what's going to happen in the future, but it gives us an idea of where the company has been. And hopefully, if they continue doing the same thing, you can get 17% basically total returns every single year, which is absolutely amazing. Return on invested capital about 38%. And last 5 years, basically, in terms of revenue side of it, they grew about 6%, and compounded annual growth rate of 6%. Current ratio, way above 1, so they've got enough money, enough liquid, enough cash out there, enough stuff they can liquidate very quickly to cover any basically current liabilities. The company are expected to grow their earnings about 7.5% this next year, and then 10% every year after that, which is absolutely healthy. This is really good. I mean, this is not like a high-flying company, but it also kind of steady Eddie kind of company. You get your 7% to 10% every single year. You get an excellent 3% dividend basically right now. And they have a solid business. So yeah, it is from my side, business side of things and growth side of things is absolutely perfect for me. Now, in terms of Morningstar, it's actually saying right now it's discounted by 1%. So $168 is basically what they expected. I think this has gone up. So let me just quickly double check, because I think, right, as you can see, of course, the stocks are very dynamic, so they go up and down. So after I've done the research, the stock, I think, has come down. So it's about 5% discounted right now, not 1%, okay? According to Simply Wall Street, it's actually saying it's about 32% discounted right now. $235 per share is where they expect. Remember, these guys don't actually give you a buy or sell ratings kind of thing, but these guys do. Seeking Alpha and Tip Ranks actually use a lot of Wall Street analysts, and they tell you whether there's a buy or hold. And according to them, both of them are saying it's a hold right now. Although it's got about 16%, 15% upside moving forward, they're saying it's a buy and it's a hold right now. But it seems undervalued all the way down, but these two are saying it's a hold now. In terms of Sharia compliance side of things, from Zoya, you can see business activities 100, interest-bearing security, basically debt, 6%, just let's call it 7%, and interest-bearing security is about 6% as well, which is absolutely fine. I like companies that have a very low debt, and this company seems to have that, because they value, and I was reading about the investor section, and the management are very proud of their basically their free cash flow and free cash flow per share and the growth of that, which is quite interesting. In terms of payout ratio, in terms of shares outstanding, you can see they have been buying back their own shares. So you're getting basically every share of this company that you own is now worth more if you had it for the last 10 years, because they bought back more of those shares, right? So the more the company buys back, the more your shares are worth right now. At the same time, you're getting 3% dividend yield on top of that, and then probably about 17% in total return, which is absolutely amazing. It's a solid business. They are in the right industry. This, to be fair, is very I'm really interested now after I've looked at it today. But my issue is I do love semiconductors, but I do own, I think, 3 companies from that side of things. So I don't want to add to it, but this is a company that I could potentially look into for the family portfolio, inshallah, moving forward. And this is what I was talking about earlier, free cash flow per share drive. As you can see, since 2004, they have been basically increasing their free cash flow per share, and the company is proud of it, and they've got the dividend side of things. Look at this, how beautiful that looks. They've increased that dividend every single year to right now where it is. So the company is very proud of these things, and they're buying back their own shares. They're investing a lot of money. They're talking about these things. Look at that, 47% reduction in shares outstanding. So this is the type of business that I want to invest in, because they put in a lot more emphasis on the basically shareholders and making sure that whatever they do, they basically shareholder oriented kind of business, grow their business, but make sure they take care of the shareholders. Because in the end of the day, of course, what we want to see is basically a business that's doing absolutely amazing, and obviously sharing that, some of that, either through dividends, buying back their own shares, reinvesting in the business, and they doing all of these things. So I really like this company, although I do have basically a few semiconductor companies like ASML. I do have Broadcom, which is basically kind of similar company there, and then I do have a Qualcomm. So because of that, I probably wouldn't touch it right now, but it's something that I'm definitely going to look into for the family portfolio, because it seems really interesting. But yeah, that's what I wanted to share with you guys. If you're enjoying this kind of content, please give the videos a like. Join us on the Patreon account, okay, where you get access to basically all of these things. And if you try it first time, if you don't like it, the Discord and whatever, then that's fine, but at least to give it a go and basically help the channel, inshallah, moving forward. I've got a lot more videos planned, inshallah, in the next few days, so keep an eye on that, inshallah. Have a wonderful day. Assalamu Alaikum.